This is not a bull market. It's a chemical reaction. Right now, the financial system is showing a level of disconnection that should not exist in a healthy economy. Markets are trading like reality doesn't matter. Valuations are floating above production, above real profit, above the actual economic ground, and the explanation is brutal. The crowd is being driven by engineered emotion, financial dopamine pumped through dreamlike earnings reports, and promises that don't match fundamentals. Here's the detail that makes this terrifying. The Buffett Indicator, market cap compared to GDP, has now pushed past 200% in the United States. History draws a cold line. Above 100% a bubble forms, above 150% cracks appear, and at 200% you're on the thinnest ice in modern history. So if you're watching this as stocks are up, you're missing the real story. Because if liquidity snaps, this doesn't correct politely. It breaks violently. But here's the part nobody is saying out loud. What if this entire rally is just the final stage before a reset? The core story here isn't one company, one quarter, or one headline. This is a systemic shift in global financial power, and it begins with a simple idea. Markets are no longer pricing value. They're pricing belief. That's why signals that should matter, real consumer stress, rising costs, weakening fundamentals get drowned out by the performance of the screen. And this isn't vague, it's measurable. CAPE, the cyclically adjusted PE ratio, shows the US stock market is priced about 110% above its historical average, meaning investors are paying roughly double what the asset is worth in real terms. Now ask the question that reframes everything. If markets are this overvalued while the real economy is tightening, what exactly is holding the system up? Because the answer isn't productivity. It isn't stability. It's expectation. Specifically the expectation that the Federal Reserve will always rescue the market. And that assumption is the fuse. The strongest claim here is simple. This isn't overpriced. It's fragile. The Buffett Indicator has crossed 200% in the US, a level historically extreme. CAPE implies US equities are priced roughly 110% above historical norms. And here's what that means in plain language. When valuations rise this far above reality, the system stops behaving like investment. It starts behaving like reflex. People aren't buying future cash flow. They're buying the belief that someone else will buy after them. It's like paying $100 million for a motorbike worth $50 million because the price is no longer connected to worth. Now notice what's missing in the dopamine-driven story. The real economy doesn't confirm the celebration. Major retailers like Target and Best Buy are cutting forecasts due to rising input costs and tightening consumers. That's not a small warning. That's the ground level talking. But here's the part nobody wants to say. If consumer pressure is rising while valuations are floating at historical extremes, this market isn't strong. It's leveraged. And leveraged systems don't fall slowly. They snap. This is where the story flips. When liquidity becomes the only support, liquidity becomes the single point of failure. The danger isn't that the system is expensive. The danger is that it's normalized. Markets are being held together more by fragile expectations than core value, and that means any shock, especially a liquidity shock, doesn't just pull prices down, it breaks trust. And when trust breaks, the selling isn't rational, it's contagious. Here's the comparison that should make you sit up. The collapse risk from a liquidity shock could be more destructive than the dot-com bubble in 2000 or the crisis of 2008. Not because the numbers are identical, but because the psychology is worse. People now believe rescue is guaranteed. That belief creates a trap. The more the market depends on the Fed, the more fragile it becomes to any moment where the Fed can't or won't deliver instant relief. Now watch how fast this escalates. Once the crowd senses that rescue is not automatic, the dopamine flips into panic. And panic doesn't negotiate, it liquidates. And when liquidation hits an overvalued system, you don't get a normal downturn. You get a cascading failure that forces the next layer of the story, the debt machine behind the market itself. Because the real engine isn't the stock index, it's the US government's debt trap. This is not a budget problem. It's a math problem with no exits. US public debt has crossed $37 trillion, and the country is spending over $1.2 trillion per year just on interest payments. That interest cost has surpassed the defense budget and consumes more than half of total federal revenue. Read that again. The country isn't paying down debt, it's paying rent on debt. And here's the loop that follows. To pay interest on old debt, the government must borrow new debt and print more money, while high interest rates, kept up to fight inflation, make the interest bill grow even faster. It's like a household earning 10 million, borrowing 20 million just to keep the lifestyle running, then borrowing again to pay the interest on the previous loan. That's the trap, and once you're in a debt trap, every year becomes survival instead of strategy. Now the question becomes, how long can this machine run before the world decides the risk is no longer worth the return? Now stack the pressure, because the system isn't collapsing on one front. It's taking hits from multiple directions at once. Real GDP growth is around 4%, while debt growth is 8 to 10%. That means the debt is growing faster than the country's real productive capacity. The system survives on the assumption that borrowing is unlimited. So here's the mini crisis stack. First, rising debt creates rising interest payments. Second, higher rates make that interest burden heavier. Third, the only short-term solution becomes more borrowing or more printing. But here's the part nobody is saying out loud. When the world begins to doubt repayment, the cost of borrowing spikes and the trap closes. The endgame possibilities are brutal. Default or aggressive currency devaluation to erase debt by force, pushing the risk onto anyone holding assets denominated in US dollars. And if that happens, you don't just get a US crisis, you get a global shock. What happens if this continues? Here's where this stops being an abstract global story and becomes a personal one. If the system breaks through debt and devaluation, you don't experience it as macro, you experience it as buying power disappearing, costs rising faster than wages, savings feeling smaller, even when the number doesn't change, because the weapon at the center of this system is inflation export. The US can export inflation through the global financial system. And one detail makes the scale impossible to ignore. US MEM2 money supply increased 40% in just 2 years, from 2020 to 22. That's not just policy, that's a shockwave. And the mechanism is simple. The US can print currency and exchange it for real goods, real resources, and real labor from the world, while diluting the value of anyone holding dollars. So when you ask, why does life feel more expensive? This is one part of the answer. If this feels familiar, say so in the comments. Because the system isn't just cracking financially, it's cracking politically and strategically too. The deeper insight here isn't the dollar is strong or the dollar is weak. It's that the reserve currency is a machine, and machines have incentives. Inflation export is an invisible form of taxation on the world. But that privilege becomes a blade with two edges. US inflation peaked at 8% in 22, the highest in 40 years, forcing the Fed to raise rates and shrink its balance sheet. Here's what that implies. The privilege becomes a survival choice. When the US can no longer maintain a strong currency because of the debt burden, it faces a brutal decision: protect the system or protect the government's ability to survive. And when it chooses survival, it chooses devaluation. Because if the world refuses to absorb newly printed dollars, demand for the dollar can collapse. This is where the story flips again. The system doesn't fail because the US loses power overnight. It fails because the world stops accepting the costs of that power. And once that happens, history moves fast. Because monetary empires don't get voted out. They get replaced. Now you're entering the near future fork. And there are two paths, both dangerous. Path one is the slow erosion. The dollar remains dominant on the surface, but its foundation weakens as debt expands, inflation cycles return, and global trust becomes conditional. Path two is the faster fracture. Financial weaponization accelerates resistance. In 2022, the US froze over $300 billion of Russia's foreign exchange reserves. That sent a message to the world: your assets are not safe if you don't follow Washington's rules. And it triggered an intensified wave of de-dollarization. And the response isn't theoretical. China reduced its US Treasury holdings from over $1.3 trillion down to around $770 billion, the lowest level in 15 years. Meanwhile, alternative payment systems are being pushed, like China's CPIS and Russia's SPFS, designed to bypass US control. Now watch how fast this escalates. Once money becomes a weapon, the world stops treating it as neutral. And the moment it stops being neutral, the search for alternatives becomes urgent. The most important conclusion here is not that the dollar dies, it's that the world is building a replacement architecture. BRICS is expanding and reshaping the global financial order, including members like Saudi Arabia, Iran, and the UAE. The bloc accounts for over 40% of global output by purchasing power parity, surpassing the G7. And the goal is clear: build trade and payment systems that reduce dependence on the dollar, with mechanisms like BRICS Pay and the use of local currencies. The threat isn't ideology, it's resources. This bloc controls key real-world inputs: energy, labor, manufacturing capacity, and raw materials. And as major economies shift trade to local currencies, Russia and China have moved a large portion of bilateral trade away from the dollar. The structural attack becomes obvious: reduced demand for dollar settlement. And if demand drops, the US loses the ability to fund deficits cheaply. That's the spine of this entire story. So if you take away one insight, make it this: the most dangerous moment isn't the crash, it's the transition. Because transitions don't transfer wealth politely. They transfer it violently from the unprepared to the positioned. And if you want the next layer, how this shift ties into the end of the petrodollar and the silent accumulation of real assets, subscribe now, because the system isn't announcing the change, it's proving it step by step in the numbers.